depreciation and how much. So we'll talk about all these details when we talk about in detail on that chapter mentioning the treatment for the fixed assets, right? So this is just the logic of creating the cumulative depreciation. This is contra account. Okay. Now it's time to construct the financial statements because we have now made adjusting entry. We delivered that adjusting entry to adjusted trial balance. Now it's the time to make financial statement. Here we go. Where this figure is coming from? Adjusted trial balance. We already closed down sales. We transferred those figures to trial balance. To trial balance, we're just picking the numbers and putting it here. So what is the formula for income statement? Sales minus expenses. So sales minus all the expenses here. So you see, we have income tax. We have net income, right? All the expenses minus interest and expense income tax. We have in net income. Net income goes to retained earning. What is the formula for retained earning? Beginning retained earning plus the net income. See, the same net income minus the dividend, and we have ending retained earning. So this is the balance that will go to balance sheet here. So we make a balance sheet. So from retained earning account, so we make cash, receivable, prepaid rent, right? All these values are coming from prepaid values are coming from, since this 2000 is coming from adjusted trial balance, right? Not the trial balance, simple trial balance, no, adjusted trial balance, because we account for all those four adjusted accounts. Number one, prepaid, accrued expenses, unearned revenue, and accrued revenue, right? See, we have our retained earning. Retained earning is added here. Assets is equal to liabilities plus unearned equity. This is how we are basically constructing our balance sheet, right, guys? Now comes, okay, before going into that one, let's take a 10 minutes break. But before that, let me just give you the idea. Okay, we adjusted the accounts, right? So what does it mean? What do we mean by adjusting the accounts? For example, the revenue, we make an entry and we have a closing balance here, right? The balance here, right? That's it. But this revenue belongs to 2014, right? So this balance is not carried on for the next year, 2015, 16, 19, 20. It means we close this book and save it to our history for our reference. Okay, in 2014, how much revenue we earned, what was the revenue, so that we can just have a cross tally and that's it. So this has nothing to do with the future, right? As compared to equipment. So equipment account, it has to do with the future? Yes, because we need to see that how much depreciation charged to this equipment and how much this assets is, this assets is going to give us, benefits from future years. It means we are not closing down this account. It means this account will remain for future. If 5 years, for 5 years. If this equipment is for 10 years, then we will be opening this account for 10 years, right? So how we close these books? It's not like that. You just close the book, paste it into your drawer, bank files or drawer, something else, save it and forget it. No. In double entry system, everything is, going through some entry. Without entry, it can be an error, it can be a fraud, and it's not like, and it's not the accrual accounting, right? So we will learn over there how we close a book. For revenue, we will open in 2015 revenue account. We will open a new book or new T account for 2015. So 2015, what will happen to 2014? We will close that book. So what will be the procedure? We will talk about this after 10 minutes break. So I'm going to pause it and I'm going to resume it after 10 minutes. Okay. Okay, guys, welcome back after the break. Now let's talk about closing the books. Okay, so which kind of books we need to close? So we need to close all the books that are related to income statement, revenue minus expense, income statement, right? And then the dividend. So all those T accounts, because what we call the books are called ledgers, and we represent the ledger as T account. So I already told you the science behind this T account. It is whole physical book. In computer science, it's a whole file. In physical, it's like a whole book. I think I don't have it. It's like just kind of notebook. There are some printed version. Okay, this is the debit side. This is the credit side. So you just save it over there in your reference. So those accounts that belongs to income statement, which are revenues, expenses, and also we close the dividend as well, right? So when we close, it means if we have the debit balance, so how we are going to close it? We create a credit balance. If we have a credit balance, we create a debit balance, right? So how we are going to close it? We close it with retained earning. Here we go. So closing the revenue, we know that the revenue has credit account, credit balance. Increase in revenue means increase in revenue means credit, right? So when we close it, we make a reverse entry. So that's why we debit revenue against retained earnings, right? Since revenue and expense are a part of retained earning, and retained earning is a part of owner's equity, right? So we close it against retaining. So expense has a normal balance of debit, so we make it credit. The next against debit. So here we go. If we want to close, so first of all, we have, for example, we have revenue here, which is, for example, 5,000. How we are going to close it? First of all, we find out the balance. Sorry. So the balance is, 5,000 here. So how we are going to close it? So we know that this is credit balance, right? We close it like so that nothing remains, right? So it's not like that you just write it down this number here and just close it down. No, we have to make entry. Everything is backed up by entry. So it means revenue is going to be debited. So what would be the entry? Revenue to retained earning, 5,000. 5,000. In that sense, when you post this 5,000 into this one, this is closed. Balance is nilled. That's it.
It's like an adjustment, right?
What?
It's like adjustment. You know the middle column that you show us?
Adjustment is before the financial statements. right? Before you are making the financial statements, you are do adjustment of the account, and then you make financial statement, income statement, balance sheet, retained earnings statement, and cash flow statement. After that, you close the accounts. That's it. So this is after you close the accounts, right? So this go to income statement, right? We see that over there. And now after making the financial statement, we close the books. Which books you need to close? Revenue, expense, and dividend. That's it. Because rest of the accounts are balance sheet accounts and their benefits last more than 1 year, so they continue, right? What if this is expense? If an expense is there, it's, for example, rent expense, 5,000, right? So if you balance it out, 5,000 debit, so that goes to income statement, and now you need to close. You already made the income statement and all the stuff. Now we need to close it. We make an entry. Entry would be retained earning to rent expense, 5,000, 5,000. So you see on credit side, there is 5,000 closed, right? So only 3 types of accounts. So these are not just account title, these are types of account. Revenue type, close. Expense type, like salary expense, rent expense, utility expense, wages, we need to close that one, right? Okay, let's go back to our slide. See, so this is the trial balance, adjusted trial balance here. And which accounts need to be closed, you see here. So dividend and all those income statement accounts we need to close so that we don't have their balance carry forward to the next year, right? So these are the balances, the income statement, right? Balances, they will move forward for next year. So we will keep them because these accounts shows worth of the business. And these income statement account shows the performance of the business. So performance of the business should be measured on year basis. This year we performed this much, okay, close. Next year we perform this one, close. But worth of the business will continue. Understand? Here we go. So if we have entry gonna be, if we are closing the service revenue to retained earning. Normal balance is credit. So we are making reverse entry. Similarly, all the expenses, you see, and the dividend as well.